Well, you might get your wish. I mean, the Fed expected to raise 25 basis points tomorrow and then, according to the market, be done and start cutting, which I know would be helpful for you. But my question, Cathie, is the result of all of these issues and the lower rates is that the market now thinks we're headed for a deeper recession and starting to price in that, no longer the soft landing camp. And in that kind of period, wouldn't you want, especially technology stocks with better balance sheets that are more higher quality than the sort of newly profitable or unprofitable and riskier tech stocks that you're in?
Well, something very interesting has happened over the last year, actually over the last 2 years. So our strategy peaked out in February of 21. A lot of our companies had done secondaries when they were booming. The stocks were booming in 2020, early 21. And today what we find, now that they have the cash and they've been cutting costs, streamlining, our ARKK fund has a weighted, on a weighted basis, a runway of roughly 6 to 7 years of cash. And our ARKG fund, which is where we would have the most questions because they are very early stage, they have, and it's because the markets demanded it, been cutting costs, raising cash, and they have 4 years of runway. So we actually think we're in very good shape, and that interest rates coming down is going to be another booster. Again, it's the valuation hit of the last year that has been so severe to our strategy, February of 21 to today. And that was all related to the Fed jacking up interest rates 19-fold in less than a year. Unprecedented. We think it's like an earthquake, not just for our strategy, actually. We now think the earthquake is rolling off of our strategy and into other strategies. And those that are cyclical, we think are going to face some quite severe challenges during the next, I'm going to say, 6 to 9 months.
Well, if that's the case and cyclical is under pressure because of the economy, because of the Fed, I mean, why have you been adding Block, for instance, the last few days? I mean, really amassing a pretty sizable position in this company, which is so tied to consumer discretionary spending.
Yes, what we're seeing with Block, Square, Cash App, we're seeing two things. It is reducing the cost of financial services, and so more people are flocking to it. And in fact, it's developing a closed loop ecosystem, and we believe could be one of the big winners in the digital wallet space, where it won't even have to interact, where their clients won't have to interact with banks. Cash App and Square will take care of that and really become the financial services company. So, and what that does is takes the number of toll takers. If you have a closed loop ecosystem, the number of toll takers in a transaction between a merchant and a consumer drop from 9 to 3. And you can find that analysis in our Big Ideas 2023 on digital wallets.
I'm assuming, Cathie, that you're going to hold to your Bitcoin forecast for, $1 million per coin by 2030. That still feels good to you?
Yes, and you can, sometimes you need to battle test. You need to go through crises to see who the real, to see the survivors, first of all, but really to battle test the infrastructure and the thesis. And again, we think Bitcoin is coming out of this smelling like a rose because of what I have mentioned previously. And I do think, though, the one thing that will be delayed is perhaps institutions stepping back and just saying, okay, do we really understand this? And once they actually do the homework and see what's happened here, I think they might be more comfortable moving into Bitcoin and perhaps Ether as a first stop, because they'll understand it more.